to kick things off, we've got 4 questions that we'll walk through together. Excited to hear your thoughts on some of the topics. And I know that we shared some of these in advance, but maybe just talk about some of the trends you're seeing in healthcare IT. Now, that's an area that you spend time in amongst a few others.
Sure. So that area continues to be pretty active amongst all the different verticals that have been active in 2023. That one's probably a little more so than some of the other more traditional ones. So a transaction that we had done and completed on behalf of the sell side party, which was called Medisys. They were acquired by Thoma Bravo, and this is all public, so I'm perfectly happy to talk about it. They were acquired by Thoma Bravo in a transaction where Thoma Bravo also acquired a company called Brightsight, and both of who were basically in the information management part of drug therapies. And interestingly, Thoma's always been active in this space. So putting these two companies together seemed to fit their one of the strategic niches, and the deal came together pretty quickly. I'd say maybe towards the end of May. And then it closed, I think, in the middle of July or the early part of August, and it was all publicly announced then. So given the lifespan of transactions in this environment, something that got done in basically, under 2 months is probably considered, record keeping. So it led to a little extra work over the 4th of July holiday, which is when I think we actually signed the agreement. So, there were some people who were felt like their holiday weekend got a little bit compressed, but you know what? As a deal lawyer, you kind of get used to that stuff, and when a transaction's ready to go, it goes. So I don't know that that deal is sort of a one-off. I think that the market continues to be interested in healthcare IT. There are other transactions that are being announced. I think Thoma Bravo actually just announced a recent transaction in the $1 billion range that was publicly announced also. So they continue to be, active in this space, as many private equity firms do.
Yep. Yeah, I think they acquired a business back in September. I think it was Next Gen Healthcare.
Yeah.
They did some cloud-based tech.
That just closed.
Yep. Yeah, that was a big one. I think that was almost $2 billion. So it was a pretty big one. I would agree with you, though. I mean, getting something done, especially initially coming together in May and then really coming to fruition in July, in 2 months, Q2 of this year, very choppy for us. I mean, we got some stuff closed, but nothing that fast. We had a company that we started working on back in March that closed in September. So we thought 6 months, pretty normal timeline, but this market was pretty good. But 2 is really, really impressive. And that company was a carve out for a sponsor in the managed telehealth healthcare IT services space. But sometimes you just have that natural fit and you can get things moving quickly. One of the things we've been seeing too, I don't know if you've seen this, is we've been seeing, I mean, AI is a big buzzword, all over. Was doing some reading the other day. You got within healthcare, it seems like 2 pockets of AI investments. So on the one hand, you have the generative AI with the large language models. So there's a company called Hippocratic AI that's gotten some investment, the VCPE side. But then on the clinical side, there's a few different companies that are doing work. So even Epic is a big EMR. They're doing some work, investing in some earlier stage companies or partnering with them to try to build out some solutions that can help. And then there's another company called Suki that does some work on the voice dictation side of things, almost like digital scribe, virtual assistant, which is pretty neat. But I don't know, it's interesting. The space as a whole seems to be, like you mentioned, and I would agree, it seems to be holding up well or better compared to some of their counterparts.
Yeah, and I think you're going to see that continue to expand. Obviously AI is here. It's not going away when nobody's putting that genie back in the bottle. So you're beginning to see coding companies and others, you know, a little bit further removed from the companies that you just mentioned, you know, trying to figure out how these new technologies, these new softwares are going to be able to, you know, be implemented in, you know, in coding, in bill submission, in data analytics, and you know, be able to extrapolate that for efficiency purposes to parties who are really touting sort of, you know, an efficient solution. So, you know, don't be surprised if you see over the coming periods of time, and maybe it's a year or two down the road, where some of those technologies are more front and center in home care or in hospice, nursing, you know, other places where that technology can be migrated over into billing platforms.
Yeah, I agree with that. That vertical of healthcare is ripe for disruption by AI, and certainly with value-based care, I think there's going to be applications that people dig into for cost and revenue purposes. But I think that's probably a good segue. I know healthcare IT is an area you spend a lot of time in, but just broadly speaking, you know, when you're working with folks on the sales side, like you mentioned, Medicis, you know, how can companies like that prepare for an optimal sale or exit? What do you typically counsel folks?
Sure. So let me take a half step back. So we're active in healthcare IT, but we're quite active in home care, hospice, staffing, DME, and really all of the service, physician practice management. And in some regards, you know, all of those transactions in terms of a process are not too dissimilar, and some of the timelines that we talked about before are really more traditional. Some deals go off on 4 months, you know, most in a normal environment take roughly 6 months, assuming that there's a process that's the
Sure.
legal affair. So if a party, a selling party, for whatever their reasons are, have decided that, you know, now's the time or soon is the time to transact, you know, we really begin, and if we're able to talk with them soon, we try to counsel them, look, this isn't, you shouldn't view this as a haphazard sort of, you know, one-off knee-jerk process. You know, it's going to take a lot of effort, going to take a lot of time on your part. Certainly there's going to be significant time on the owner's part, on the rest of the management team part. So you really have to take that, you have to take that with a little bit of a grain of salt, and recognizing that, you know, no good outcome is coming from something that wasn't really pursued, you know, thoughtfully from the beginning. Figure out what your goals are. Are you exiting from this business entirely? Are you an older legacy owner who says, you know what, I've really had my fill from a career perspective. I'd like to monetize my asset, you know, and ride off into the sunset, and maybe go do some other things. Some others, you know, want to stay with the business and say, geez, I'd like to be here for another 2 or 3 or 4 years. Sometimes the other transacting party needs that continuity of management to make sure that the business is either integrated or handed off appropriately. So those are really high level thresholds, but let's get into a little bit
Sure.
more, you know, meat on that. Assuming you've made that decision, you kind of have a plan as to what you want to see out of it. Start to assemble your team. And this isn't a shameless plug for DAG. This is hire a banker. I mean, just because the company next door to you says, we love you, we want to buy you, we're going to give you a value, you don't know what you don't know. And you need to hire that professional expertise to be able to counsel you and let you know that, hey, that's a great offer. But others out there that might be willing to pay more, or may integrate with your business better on a post-transaction basis. So make sure that you've got your investment banker lined up. Again, not sounding like a shameless plug. You need competent and experienced transaction counsel who know how these deals are structured and what you need to do from A to Z to get you to the other side in a way that you expect. And then, of course, you need to fill out your accounting and your other professional advisors to complement that team. And then start to think about who you're going to let into the tent internally. I mean, you can't do this all by yourself if you're the owner. So is it some members of your executive team? Is it your IT people? Is it your operational people? You know, you got to start thinking about that. And then I guess some of the other buzzwords are prepare. You know, make sure that all the problems that you know about, or are knowable, you've identified them, and you're trying to figure out ways that you can either correct them if they're correctable, or come up with a rational or cogent explanation as to why these may not be as significant as somebody coming in externally to your company is looking at and maybe not fully understanding, but at least have that thought out. So that's really important. Maybe you want to do, in conjunction with your banking and legal support, you want to do a sell-side Q of E, a quality of earnings report. That will help you flesh out any kind of financial issues that you have, which are going to be really important in driving the initial part of the transaction. Not everybody does a sell-side Q of E, given that buyers are always going to do something, on their side. But I think more and more people are jumping onto that ship. Have your files and records orderly and neat, and being able to respond to a question when you get one from a buyer or from their representatives. There's nothing more disheartening to a buyer than a seller who can't provide the answer to that, doesn't really know, is unresponsive. It takes 2 weeks to get back to an answer for something that seems, pretty apparent and you should have your arms around. And then anticipate that you're going to go through a reasonably fulsome due diligence process, either financial, operational, clinical, and there may be some other aspects too, depending on the particular business. So if you're thinking about all that stuff, you're beginning to line up these resources and thinking about this process 6 months before you're even beginning to go to market. And if you do those kinds of things, I guarantee you it will pay dividends once you get into the process, and clearly as you get in the process and out of the process.
Yeah, I think that's really well said, really thoughtful answer, Les. And a few things that you mentioned stood out to me. First, you mentioned 6 months before. I think it's really important to start in advance. And I think you also mentioned the quarterbacking of a process, whether that's your banking team, maybe it's a third-party due diligence team on the financial side, maybe it's the team that's helping you on the clinical side. Clinical audits can be really helpful, especially from a regulatory standpoint, but there's also the legal side of it as well. And I think, not a shameless plug for you guys at Robinson Cole either, but having your counsel involved even earlier can be really helpful, especially if there's any switches or any major regulatory issues or clinical issues or HR employee issues that need to be lined up in advance, because that's an area that you can also get tripped up on. And sometimes that starts years in advance, right? I mean, you want to run your business like you're going to own it forever, but be prepared to sell tomorrow, just like some of the professional investors do. So I think everything you said really resonated. And I think it's hard to underscore the importance of preparing in advance.
Yeah, and the effort and dollars that you're going to spend in doing these prophylactic things early in a process will invariably save you aggravation dollars down the road, and more likely lead to a successful outcome because you've lined up most of those things. I mean, just to segue a little bit, really wasn't exactly your question, but when we're involved with a client, particularly on the sell side, sometimes we get engaged later and we get the letter of intent, and great, we're happy to do this deal, but geez, if we could have had a bite at that letter of intent before, we could have set the tone, we could have been able to negotiate a number of things that reasonably sophisticated buyers are not going to be surprised by, and we would have cleared away a lot of the cobwebs for really a very little amount of time and effort. So just because you've got your legal team involved in the beginning doesn't mean you're spending a lot of money. In fact, if anything, it's going to save you money, down the road, fighting in a purchase agreement about things that you would have already plotted out in the letter of intent.
Yeah, and I think sometimes folks don't recognize that there's 3 levers when it comes to a deal. There's the speed, the certainty, and the value. You can't necessarily have all 3. You can strive to have all 3, but you might not be able to have it. I think speed you can usually get ahead of by being prepared in advance. Value, same thing, particularly around, you mentioned the return on investment. Someone has a business that's generating $5 million in EBITDA. If you do a QV, you'll probably find at least $500,000 of adjustments, depending on what market you're in. a mid-single digit, high single digit, low double digit multiple, your return is incredible, right? So whatever that multiple is. Same on the clinical side, except it could be more jarring where, maybe there's some issues that would result in more structure. You lose cash at close, or you're in a situation where your deal doesn't close at the altar, which you have all the fees that you accumulated, you have to pay. And just the pain of going through that really is tough.
So let's talk about the clinical part, because in our experience, more deals don't get done because there's a clinical problem. Something gets surfaced, and different outside advisors to buyers, approach these differently. Some are more conservative than others, and sometimes you're able to work your way through those issues, and everybody can get comfortable. And there's usually a way contractually that, unless it's really a systemic issue, that you can typically fix that by allocating risk or arranging for supplemental escrows or things of that nature.
Sure.
So doing that stuff is really, really, really important. And to your point, if it's a $500,000 item times an 8 multiple, this is a huge amount of money, and you're doing yourself a huge disservice by not taking those steps in advance and making sure that you've cleared all of the issues. Or if in fact you've identified one and it's clinical, you now have the ability to shape the response and the messaging that you're going to give with that before the buyer comes in and having to discover it on their own. So again, we ourselves and you clearly can't state that strongly enough, that those things are so imperative to any deal process.
Definitely agree with you. And rather than having a full-on, cash retrade, the escrow solution, a special escrow, we've seen that before. I think that's a really good point to make, especially if people reading or listening to this are going through a deal and they're encountering issues. There's other ways for you to kind of manage the risk, like you mentioned, versus taking a cash discount, which is the last thing that you want. Speaking about structure and increased due diligence, how do you see things shaping up for 2024? Do you see a continuation of some of the diligence trends? What do you see in valuations? What if you had a crystal ball, Les? What do you see?
Well, a lot of things to unpack in that question. So let's take them. I think from all transactional professionals' experience, the second half clearly of 23 has been choppier than I think certainly anybody would have expected or necessarily hoped for. But given some trends recently in the home care space, we got the final rule that came out on Medicare rates. Many of us, myself included, when the preliminary rule came out in June, thought that cut of about 3.5% wasn't going to stick, and we'd end up being either flat or slightly positive, which is in fact how it ended up. So there's some degree of uncertainty that's been taken off the table there. Inflation seems to be moderating a little bit. The numbers were pretty good that came out this week, and clearly the stock market responded, quite favorably to that with almost a 500-point uptick. The Fed in its last meeting didn't raise interest rates, so there was a little bit of a glimmer of hope there. So to hark back to that campaign phrase from a number of years ago, it's the economy, stupid. I guess I would substitute that and say it's interest rates, stupid. And that's really what's been, in our experience, more than almost any other factor, what's been really causing a hiccup in deal flow. People got used to an environment where basically there was no cost, more or less, to capital. So there was a greater delta between the equity spread and the finance portion of it, and that led to the ability to take a little bit more risk, to be a little bit more generous in multiples. So I think if we get into a period of at least more stability, I think that will help the deal market percolate a little bit more. Clearly, there's a tremendous amount of unspent capital that's reaching to get deployed, and it's only a question of when that's going to break out. And if the things that I've been talking about just in a minute come true, I think that will certainly be an impetus to doing that. Services business and healthcare continue to be more or less value-added propositions. You know, they're strong. They can create efficiency and ultimately cost savings to the system. And frankly, healthcare continues to be a defensive investment strategy. So if you're going to put money in a European investment fund overseas and, you know, things are going on there, or maybe deploy some of that capital to our domestic healthcare system, it's probably not hard to figure out which one is, you know, a little bit more stable, a little less volatile. I think we're also beginning to see a retrenchment of valuations from the giddy days of 2021 when you know there was a stampede to get transactions done. So I think that's taking longer to normalize, but we're definitely seeing you know more of that. And diligence processes are just taking longer. I think as people are a little bit more concerned about risk, they're turning over more stones and kicking more tires as compared to earlier periods when you might have looked at the same issue and those parties might have said, that's not really a concern. We can move off, off on that. But again, I think that you're going to start to see some of that abate a little bit more as we get into 24. Probably in the second half of the first quarter of 24 and getting deeper into the year. The clock marches on, and when you get to a certain point in the calendar, it just becomes really more difficult to bring transactions to market and to complete them. And certainly, where we are in this time frame now, unless you've got a deal that's in the pipeline now and it's really being worked actively, it's going to be pretty hard to complete something in the end of 23. So some of those are even going to roll over to 24. Now, all of that being said, Mel, we're getting a lot of inbound inquiries from parties who are talking about transacting much more so than we were seeing 3 or 4 months ago. So that always leads to the thought that some of those deals are going to take, and we're going to have more transaction activity in 24.
Do you think there's a reason why they're reaching out now more than later? Do you think it's, as you mentioned, an adjustment on behalf of some of the buyers to the rate environment, or do you think it's that some sellers have sat on the sidelines and they're really raring to go because there's, as much as there might be pent-up demand and cash on the sidelines on the buy side, on the sell side, they're ready to make something happen?
I think it's a number of things. I think there's a little bit more comfort with rates. Now, of course, that could go sideways in a heartbeat if
Sure.
Systemic happens, and but assuming that we're on this continuing trajectory, it doesn't feel like, even if rates hold steady or maybe at some point in the not too distant future decline a little bit, we're not going to get back to the environment we were in 2021. So I think people are beginning to realize that, that valuation train has left the station. It's not coming back. And if we really want to transact, waiting another 2 years probably isn't going to really be in my ultimate best interest. So I do think that you're getting a little bit more of a thought process that, geez, this is probably the environment we're going to be living in, and that will inspire and motivate people to want to transact. It's also a good time to be positioning deals for kicking off after the first of the year. So if you're beginning to do that spade work now, you've hired your banker. They're helping you prepare your book, start to get the Q of E, done. You're going to be well positioned to run hard when you get into the new year. There's capacity in the Q of E market. We didn't talk about rep and warranty insurance, but there's capacity in the representation and warranty insurance market. There's capacity in outside advisory firms who are doing clinical and other kinds of support work. So if you're thinking about a deal in Q1 or Q2, start talking to those people now, get them lined up so that you're really ready to hit the ground at the earliest possible moment, and not start to think about that 3 weeks into January. Now you're already pushed back to the beginning of March.
Certainly. I mean, we're seeing something similar where folks are reaching out to us, and through some of the conferences that we go to as well. A lot of folks are thinking about, maybe it's not time for a full exit or buyout, but maybe it's a partial exit or a recapitalization. Maybe get some chips off the table, because you're right, this environment is here to stay for a while. Even if we have some modest decreases in the rates that are today. And we want to be positioned to grow in the future because we know that there's really good macro trends in the healthcare space. We were looking at some of the deal data as part of this healthcare IT report we're putting out that this is going to be featured in this fireside chat. And we counted a total of 134 transactions over the last 12 months through Q3 of this year. That was within, healthcare software, telehealth, and then managed and regular healthcare IT services. And one of the big trends that we saw, and this resonates with what you said, Les, was, there was a big pullback from private equity because of the rate environment. There's certainly a herd mentality there. For the first time in a long while, there's actually a majority of transactions that were strategic versus financial, which, as we look back at our deal data, it's been a half decade since we saw that type of drop off in the private equity buyers that are increasingly, especially in the lower middle market, doing more and more deals. And as we look back on the previous year and try to think about what 24 looks like, it felt like the sentiment of the year was so negative when we kicked off. Everyone thought we would be in a recession. We're having this meeting on November 16th of 23. That never materialized, but I think lenders reacted in a certain way where they tightened their belts, covenants got harder, rates obviously went up, and I think a lot of the private equity folks, they got scared. And like you said, there's money on the sidelines. We're pretty bullish on 24. When in 24 things really start to shift, I think it's hard to tell, but I do think, in terms of pipeline and in terms of backlog, we're seeing some positive factors that are coming in, and they give us promise for 24. So
yeah, a couple of things to keep in mind. So just to piggyback on your last thought, and then I want to mention one other thing. There is a little bit of a herd mentality. If you start to see transactions coming to market and getting done, it will inspire people to put their toe back in the water and go, okay, it's time for me to pull the trigger either on the sell side or the buy side. One thing to mention, and I'm not necessarily suggesting you're going to be seeing a tsunami of this because I don't think that will be the case. But we did a webinar yesterday here at my firm on what many are calling the impending debt maturity cliff towards the end of 24, beginning of 25, and then to some extent continuing later into 26 through 28. There's a lot of leverage out there, and you may end up seeing some transactions that are coming to market because the leverage is too high and there really isn't enough capacity to refinance that particular debt. And certainly selling all or a portion of a company to either take that debt down or to take it out, maybe perhaps an unintended consequence of the high leverage that was going on in 21. So we'll just have to wait and see how that all plays out. But when you put all of those factors together, it does feel like we're gonna have a more robust environment in 24.
Certainly, and I think and maybe this goes beyond 24, like you had mentioned, but the debt overhang also affects valuations, but especially for the PE firms that they over-acquired or they overspent back in 21 and 22. And that's going to put some pressure on them, maybe not to do a recapitalization or a sale from a growth standpoint, but on a defensive footing. Because as you mentioned, they're going to have to bridge liquidity. They're going to have to be prepared to deal with their debt service. So couldn't agree more. Les, we covered a lot of topics. Anything else you'd like to talk about?
Yeah, I think just one thing in terms of reimbursement for folks that have been involved in the healthcare space for a long time. Reimbursement is just a fact of life, and you shouldn't necessarily gear your transaction philosophy to, am I getting a rate cut this year? Am I not getting a rate cut? I think you need to take a somewhat longer view, on that and see how you're going to manage and price the business, because those things are not going away. Particularly on the government-funded side of the equation. So I continue to be the glass is always half full and a little bit bullish. I've been doing this for 30 plus years, hundreds of different transactions across these various verticals, and markets do go up and they go down. But I think if you look at the long-term trend, for healthcare services in particular, you'll know that it's an important and vital part of our economy and an important and vital part of creating efficiency and delivering care to people, and that continues to make it, a really good investment alternative.
Les, couldn't agree more. Appreciate the time today, and look forward to speaking again soon. Sure we will.
Take care.
Likewise.